Hello. This video will discuss the double entry accounting system. So for companies to prepare their financial statements, there must be a system in place to accurately capture the vast number of business transactions it has each year. The most widely used system is the double entry accounting system, and it's been used for hundreds of years given the effectiveness of this system. Now we know that the accounting equation is composed of assets, liabilities, and stockholders' equity. Each of these can be divided into accounts. For example, an asset account is cash. Now we've previously discussed how transactions increase or decrease a specific account under the accounting equation. In practice, however, accountants will describe these increases or decreases with the correct terminology. So instead of saying an account is decreased or increased, an accountant will say that the account is debited or credited to reflect the impact of the transaction on the accounting equation. Now, I have on the screen a T account, which is used to show how transactions affect a specific account. So we'll see the account name at the top of the T. On the left side, we will add debits, and on the right side, we will add credits. Now, debit is just a name for the left side of the T account, and credit is just a name for the right side of the T account. In a T account, a company will record the transaction dollar amounts on the credit or debit side, depending on the effect of the transaction to the account. So to calculate the balance of an account in this T account mode, we will total the numbers on the debit side, total the numbers on the credit side, subtract the smaller number from the larger number, and then draw a line close to the bottom of that T account and write the difference between the smaller and larger number on the side of the larger number. We can get into how that looks here in a second, but those are the basic rules. Now, if the sum of the debits is greater than the sum of the credits, then the account has a debit balance. Vice versa, if the credits are larger than the debits, then there is a credit balance. And then if the sum of the debits and the sum of the credits are the same, so the debits and credits are equal, then the account has a zero balance. Using a double entry account requires that each transaction has at least two accounts involved with at least one debit and one credit. We have talked about how two accounts need to be involved in transactions in the past, just not in debit credit format. We know that when we show the effects of a transaction on the accounting equation, that we must show a balanced equation. So if something happens on the left side of the equation, something also must happen on the right side. Or if there's something on the left side that's an increase, we could also have a balancing decrease on the same side, therefore resulting in zero effect. And then using the double entry accounting method, the total number of debits must equal the total number of credits. Now, T accounts are used to just visually represent a ledger account, where all T accounts are maintained in an accounting system. So it'd be a record of all accounts, and they'd be shown in a T account form. So there are some rules with how debits and credits affect specific accounts. So here I have the basic accounting equation first, where we have assets equals liabilities plus stockholders' equity. And then we expand it out further to we're used to the first four boxes: asset equals liabilities plus common stock plus retained earnings. And then the last three boxes are the different types of accounts that can affect retained earnings. And they're listed based on the effect to retained earnings. So we have dividends, which decrease retained earnings, being subtracted; revenues, which increase retained earnings, being added; and then expenses, which also decrease retained earnings, being subtracted. And then below the spending accounting equation, within the T account, we can see how debits and credits affect the specific account. So assets are increased by debits, liabilities are increased by credits, so on and so forth. You're welcome to study this table, but I also have a simple mnemonic that can help you remember how accounts are affected. So down here I have the dealer mnemonic. The DEA, everything before this line, is affected or increased by debits. And the LOR is increased by credits. So the D stands for dividends, the E stands for expenses, and the A stands for assets. Dividends, expenses, and assets are all increased with debits. And then on the right side, we have liabilities, owner's equity, which consists of both common stock and retained earnings, and revenues, which are all increased with credits. And so the normal balance of an account occurs on the side of increases. So the normal balance of an asset account would be debit, because debits increase the asset account. So for each transaction the business has during an accounting period, the company will analyze those transactions. And when analyzing the transactions, the business asks themselves, what are the items affected by this transaction? After the analysis is done, the accounting equation has to balance. We have been analyzing transactions all semester, so this step should be relatively easy given our time spent on using the horizontal financial statements model. We know how most common transactions affect the balance sheet, income statement, and statement of cash flows. Now, after the transaction is analyzed, the debit credit rules are used to determine how to record the transaction. So let's look at an example. We have an example asking us to record the following transactions for Mac Corp using T accounts, and then calculate the ending balance of the transaction. So the first transaction, we have Mac Corp receiving $10,000 cash by issuing common stock. Now, before we can record this in a T account, we must think about the two accounts, or the two or more accounts being affected by the transaction. So Mac Corp is receiving cash. So we have cash increase. And then they receive cash by issuing common stock. So common stock is also increased. There are no other accounts affected by the transaction, so we can go ahead and record these in our T account. All right, cash in this account. We have cash increase. So cash is increased by the receipt of $10,000. An increase in cash is a debit, because debits increase assets and cash is an asset account. Therefore, we have $10,000. I'm going to just put a number 1 here so we can remember which transaction this is. It's not always, you won't see that done in practice, but just for our purpose of the video. All right, we said cash was one part of the transaction, so that's our debit. Now we have another part of the transaction, which is common stock being increased. Common stock is an owner's equity account, and we know that based on our dealer mnemonic. Owner's equity is increased with credits. So I'll put common stock just over here out of the way for now. Common stock account is increasing by $10,000, so that will be a credit to that account. And again, that is related to number 1. All right, so we have a debit of $10,000 and a credit of $10,000. We have a balanced equation. Number 2, we have Mac Corp buying $500 of supplies on account. What are our accounts being affected by this transaction? Well, first we have supplies increasing because the company bought supplies. Now, how were these supplies paid for? They were paid for on account, meaning the company will pay for them later, they are taking out a line of credit. Because of this, we will consider the accounts payable account. The company will pay for these in the future. There are no other accounts being affected, so we have supplies, which is another asset account, being increased by the number of, or the amount of supplies bought, and that was $500. So we'll have a debit to the supplies account, and I'm just going to put number 2 here to remind us that it's related to number 2. And then also the accounts payable account is being increased. The accounts payable account is a liability account, and liabilities are increased based on, or liabilities are increased by credits. This account is being credited for an increase. All right, next we have the company providing $2,000 of consulting services in exchange for cash. Well, if they're providing consulting services, the $2,000 must be services revenue. And the services revenue are increasing because the services have been provided, we can recognize as revenue. And the services were provided in exchange for cash. So cash is received, so cash is increased. So let's go with the account we already have here. Cash is being increased. We know that cash is an asset account. Assets are increased with debits. So we'll have a $2,000 debit to the cash account. The other account being increased is the services revenue account. We're going to show it separately from retained earnings. And services revenue is a revenue account, and based on our dealer mnemonic, revenues are increased with credits. So we'll have a credit of $2,000. Number 3 to show that it's related to the third transaction. All right, lastly, we have salaries being paid by the company of $750. Well, if salaries are being paid, that means cash is going out. Also, salaries being paid means that we're showing an expense related to salaries, so related to our employees. Salaries, expense. So we already have cash here. We'll go ahead and show a cash decrease. And it's important to note here that even though we have already 2 debits, we can go ahead and start our credit up at the top line because we will just sum these and put the total on the larger side of the account. Or not the total, the difference of both sides on the larger side of the account. So cash is decreasing. As such, we are crediting that asset account because credits decrease cash because debits increase cash. And then also we have a salaries expense account that we should show changes in. And salaries expenses are increasing. We're showing an expense related to our employee salaries of $750. So we have a $750 debit, a $750 credit. We have a balanced transaction. Now we need to calculate the ending balances for the period. We'll start on the right side because this is easier. We will add a line. And there's 0 on the credit side of salaries expense, 750 on the debit side of salaries expense. So salaries expense has a $750 debit balance because debits are greater than the credits in this account. Right, I've drawn my line across the bottom of all accounts. Next, we'll look at the services revenue account. We have 0 debit and 2,000 credit. So we have a $2,000 credit balance on the services revenue account. Common stock, 0 debits, 10,000 credits. So there is a $10,000 credit balance in common stock. Accounts payable, there's 0 debits, 500 credits. So the balance is 500 credit. Supplies, there are 500 debits, 0 credits, so there is a $500 debit balance. And then on the cash account, we have 10,000 plus 2,000 gives us 12,000 on the debit side and $750 on the right side. Obviously, the debits are larger, and the difference is 11,250. So the cash account has $11,250 debit balance.